Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. On this episode, we're going to be talking about home prices coming down and interest rates going up and what it means for mortgage qualification if you're looking to go out there and buy. You don't want to miss it. Stay tuned. If you're watching this video on the Team Sessa YouTube real estate channel, thank you again for all your views, all your comments, and thank you again for hitting that like, share, and subscribe button and getting this content out to as many Canadians as possible. Don't forget, if you want to book a free consultation with myself or Santo, you can do that in the description box below by clicking on the Calendly link, as well as don't forget to leave those comments and thoughts on our video in the comment section below. And now back to the video. Mortgage affordability has become a very hot topic for many Canadians and many young first-time home buyers, even move-up buyers, as we start to see the real estate and mortgage marketplace change with obviously inflation, cost of goods and services, the ability to save, wages, and so many other factors playing into it. So we had a phone call from a client actually that we talked to who was very, very concerned with their ability to be priced out of the market, even if home prices were to come down as interest rates were to go up. And they were basically very validated in their concerns. And we had a discussion with them basically at a very high level, just taking their parameters into context and looking at if home prices were to come down and interest rates were to go up, what it would mean for them qualifying for a mortgage. So that was a very important conversation. And I'm going to go through some of the slides that we presented with them just to give not only the client as well as some other clients that might be watching this or other viewers that might be concerned with the same fears. Should we wait? Should we buy now? Obviously, this is something that is very important and on the top of a lot of home buyers' minds, as a lot of them feel like they've been sidelined or they're waiting for the right formula for them to purchase a home. Obviously, there's no right or wrong answer. We're not going to sit here and tell clients, hey, you need to go out there and buy a house today if you're not prepared and you're not armed with the right data. And I think that is the most important conversation that we as mortgage brokers should be having with our clients as we move forward. So there is no context in regard to, obviously buying a home for less, no matter what the interest rate is, will obviously be the best case scenario as you are borrowing less, even at a higher interest rate. The cost of borrowing may go up, but obviously you're saving money on that purchase price. Now, the question remains here in Canada is the qualification in order, or the barrier to entry with the qualifying rate of, as interest rates go up, so does the qualifying rate, or so does the numbers that you're qualifying at. Even if that house price was to decline, where do you draw the line? And basically, how do you present that information, or how do you deduce that information or look at that information and understand it a little bit better? So when we dive into these numbers, when we look at the estimated income required, and obviously some of the interest rate calculations that we're using, they're basically hypothetical scenarios. The income required, although is as close to the client's particular situation regarding the mortgage amount. One thing that's important to understand in those amounts is that we have not factored in, obviously, property taxes or any maintenance fees, as we don't know the property, as well as the client scenario was one that maybe not a lot of Canadians find themselves in. These clients had no debts, no car payments, no lines of credits, no actual consumer debt, which was very, very refreshing. I know there's a lot of Canadians out there that might find themselves in a very different situation, but that's why it's more important now than ever to speak with your mortgage professional, have the conversation about your qualification and how lower home prices and higher interest rates might impact you. So what I want to do is just dive into a couple of scenarios that we ran for the client, which they asked us to do. And we were more than happy to oblige and say, look, let's take a look at some of these options for you based on what your concerns and fears are. So we'll dive into the first slide. In this slide here, what we did is we basically looked at the client's desired purchase price. Now, this was a home that was previously priced a little bit higher than that, just below the $1 million mark. Spoke to the realtor. They're thinking that maybe now in these current market conditions, they might be able to get this house for around the $950 mark. Now, obviously, each market is different. Obviously, this is exactly what the clients were asking for. And we said, look, let's pretend for a moment that the purchase price is $950 and that won't change for the next duration, let's say for the rest of the year. We don't know. Obviously, we don't have a crystal ball, but we're running the scenario. Down payment is 20%. Mortgage amount has not changed because the purchase price has not. They have 20% to put down. Obviously, these numbers will change based on the down payment and obviously the interest rate. So what we did is we looked at the current rates that are available for this particular client. Obviously, we are in the process of completing a pre-approval for them. So rates are changing on a weekly. Every week they're changing potentially on the reaction to the bond markets. Obviously what's happening there as 5-year fixed are increasing by the moment as it appears right now. And ahead of June 1st, where we're going to see the variable rate mortgages and prime lending and policy rates go up potentially 0.5%, 75, 1%. You let me know in the comments what you think is going to happen with the Bank of Canada prime rate on June 1st. So basically, we looked at the mortgage payment for the client based on the 424, and we said, look, the income required qualify for the $760,000 mortgage at the 6.24% here is basically $174,000. And obviously, the longer the client would wait in this particular scenario, if home prices were to remain moderate to level, basically would be costing them a lot more money in principal and interest. Not to mention the income required based on the stress test changes, which is the contract rate or the discount rate plus 2%. So as that rate goes up, let's say it goes up 0.25% from 424 to 449, basically, you're looking at a qualifying rate of 6.49, increasing that income requirement by $4,000. And this is a very, very important discussion to have with clients. As we're basically rounding these numbers off sort of to keep everything as clear, as concise as possible. But you can see, the income requirement to qualify for that mortgage is definitely going to go up. And it all depends on your income as a household, as an individual, and qualification, and obviously how that's going to impact your total principal paid over the 5 years and what you're actually paying. So that's an important distinction. Now, what we did is we also took the same scenario and said, look, what if we were to discuss prices coming down and rates going up? Obviously, we are making predictions in regards to how interest rates are going to impact the housing market. We don't know exactly if there's an algorithm or dollar value. So we're just making an assertion that let's say the interest rate goes up 0.25%, home prices drop 50,000. Let's see, as we have seen now, basically with the rise in interest rates, we've seen some diversion in the housing sales, as well as the volumes and the medium sales. Everything's sort of changing week to week. So just to keep an eye on that. Looking now, let's say 950 to 900, obviously the qualification, we see the interest rate go up. We see the mortgage amount come down, right? The income required to service the actual mortgage payment is around 136,000 at 4.49. But if we increase it by the qualification to stress test it at 6.49, which is where we're going to be, comes down the required of 169,000 as opposed to the actual 136. So what that means is, just to be very clear, is to service this mortgage, you need $136,000 under the current bank's guidelines and parameters for what's called gross debt servicing and total debt servicing. Obviously, these clients, as I mentioned earlier on, they do not have any debt. So it's basically around 39%. There is room for exceptions when you are putting down 20%. But to keep this in line, as I said, this number will jump up if you have debts and property taxes and maintenance fees. And then as you can see, obviously, if it goes up 0.25%, you're still seeing that income range change, not too crazy, but from 174 to 158,000. So obviously, even if that home price was to drop down to 800, right? So let's say from 950, $150,000 swing. Even if the rate was to go up to 5%, hypothetically, right? Obviously, we don't know where that's going to be, but let's say in this particular case, they would still need to show 158,000 of total income to qualify. And as mentioned, that's providing that the interest rates don't tip over 5% for a 5-year fixed in the coming times, or maybe they don't, right? So we're just looking at this as how their income will qualify them for what amount of mortgage. What I do want to do is basically look at the breakdown. What we've done is we've broken it down, let's say for the fixed rate mortgages per 100,000. So it's a little bit more generic, a little bit more clear for maybe some viewers out there who are maybe, I don't need a $700,000 mortgage. I'm looking at maybe a $400,000 or $500,000 mortgage and how that's going to impact you. So we looked at it and we broke it down per 100,000. Same idea, $100,000 mortgage, rates going up 0.25% here. and you see the mortgage payments changing based on the rate, the income required to service this amount of mortgage, but the actual stress test amount. And basically here we're looking at it at around $22,000. You're looking at $22,000. And basically, you're considering all this information here and saying, look, from $22,000 to $24,000 as the interest rates go up, and you can sort of do, your math depending on how much income you're earning per 100,000 with no debt, how much income you would need to support a $400,000 mortgage. I would be amiss if I didn't also address the variable rate component and look at the difference between qualifying on the fixed and qualifying on a variable. Obviously, we are taking the assumption that interest rates are going to go up 0.5% each and every time. Probably not likely, but let's play with the worst case scenario over an average of a couple of increases. And also take into consideration the discount. One important thing when I look at the discount, and as I said, this is just an assumption. Obviously, we have the ability to be right. We have the ability to be wrong. Generally, what happens and what we've seen when the Bank of Canada increases its policy rate, some of the banks make adjustments on their prime, obviously by the increase by the Bank of Canada, but sometimes they reduce that actual discount so it's not as aggressive. So a few months ago, you might have saw prime -1. Right now, we're seeing prime minus 50, 60, 40, depending on the type of product that you're looking to get into. That discount is starting to dwindle as the prime rate goes up. And not too long ago, in the not so distant past, over a few years ago, we were at points where there was basically no discount to prime, it was just basically prime. So take that into consideration. This is just some rough numbers. I'm taking the stance that if we see interest rates go up 0.5%, we're going to see that discount rate go from, let's say, 0.5% to 40, 30, 20, 10 basis point runs. Basically, how that's going to actually impact your current variable rate mortgage. Obviously, if you're adjustable or variable, that will depend on how your back end or payments change. But let's say you're taking a $100,000 mortgage at 2.7%. It's about $404 per $100,000. So that's a key component to understand. Now, looking here at the qualifying rate, it's 5.25%. So that doesn't change in this particular scenario, as you can see, because the actual contract rate is below, and then we add 2, it would be basically 4.7. So we have to qualify it at the minimum of 5.25. So it's the lower of the two. So if it's 5.25, we use 5.25. If it's higher, we use the contract plus 2. And you'll see that down here where it goes from 3.30, then we have to qualify a plus 2 to 5.30. And you can see here the income required is a little bit less, right? It's a little bit less than it would be on the fixed rate at the highest rate of 699 as opposed to 650. So this is a major thing that we're seeing with a lot of clients who are looking to qualify for the max amount of mortgage that they can, obviously parameters permitting, but variable rate mortgages seem to still be the most attractive for a lot of clients, whether you agree or disagree. Obviously, it's for clients looking to try to get in, and particularly for these clients, they were weighing out the options as the income required for them to qualify for the mortgage. Every single $1,000 income required would definitely change the outcome for these clients and what they would qualify for. And one important thing, as I said, they were definitely coming to us from a point of concern. So I wanted to just basically stress, as I know these clients are not alone in their confidence in the market. Obviously, that is a huge push factor. When confidence is up, we're going to see a push for buyers as we start to see homes, selling for ask or over ask or below ask. That confidence is definitely changing in the marketplace. Very important is that the clients' parents were telling them, hey, you know what, you should get in now, because if you qualify now, get in when you can. Because if that changes, then basically, even if the home prices come down, the homes that they were looking at were basically not going to be achievable. Now, their friends were telling them, on the other hand, that they should wait. Now, obviously, as I mentioned earlier on, we don't tell clients what to do. We present them with the data and say, what is your potential for your income earnings? Are you on a fixed income? Are you on salary plus commission? Do you work a side job? Do you have more money to put down? All these things weigh into the decision whether if home prices come down and rates go up on whether or not to execute on a purchase and go out there and get into the market sooner than later. I want to hear your thoughts and comments on it. Obviously, this is just a very high level conversation about looking at income required with the stress test rules as interest rates go up, and obviously how it's going to impact certain buyers in the market. Obviously, if both of you, both a couple or a partner making, $200,000-$300,000 a year, these numbers are not going to make any sense. But if you find yourself in other parts of Ontario, maybe working in sectors that don't pay as aggressively, or you haven't seen a wage increase in so long, obviously, maybe these numbers will hold true to your decisions. But looking at the $100,000 mark, it's around $20,000 to $23,000, $25,000 per 100,000. So basically, if you do the math, let's say, you want to qualify for a $100,000 mortgage, you need to be over $100,000 of combined income and no debt to qualify for a $500,000 mortgage. Now, in certain parts of Ontario, maybe that's still possible. I know definitely in other parts of Canada, that's definitely still possible, as we have clients that are moving outside of the province for affordability reasons. And that is something that we could see moving forward. Just really wanted to address this concern and talk about something that a client brought to our attention. And hopefully you found this video helpful. And hopefully if you did, or you know someone that would benefit from learning a little bit more about how higher interest rates and lower home prices could impact them, please feel free to share and like this video, hit that notification bell so we can get this content out to as many Canadians as possible and help bring that financial literacy and basically bridge that gap. Now, we'll leave the video here. I hope everyone had a great Friday, and I hope everyone a wonderful weekend ahead. And thank you again for clicking, and thank you for watching the video this far. Until next week, stay tuned and have a great weekend.